Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Visa.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. When you look at a company like Visa, you're not just looking at a stock. It's more like examining a piece of global financial infrastructure. And the whole story really starts with its competitive moat.
Right. And that moat is everything for an investor. So let's unpack that a bit. You say it's unmatched. What does that actually look like, and why does it make them so hard to compete with?
Well, the number you have to wrap your head around is 4.5 billion.
4.5 billion cards.
4.5 billion cards in circulation globally. So, whether you're in New York or a small village somewhere, chances are they take Visa. That ubiquity creates incredibly high switching costs.
Meaning, if a small business owner decides to drop Visa for some new, cheaper competitor, they're basically cutting themselves off from billions of potential customers.
Yeah.
The pain is just immediate.
Exactly. And then you have the cost efficiencies on their side. The sheer volume they process is enormous. They don't have to convince people to use the network because the network is the product. It's an infrastructure play, really.
And it's a remarkably asset-light infrastructure. I mean, they're not running giant factories. They're running digital rails.
That's the key. And that asset-light model flows right to their financial stability. They generate huge amounts of free cash flow, which, easily covers their $20 billion in long-term debt. They're built to last.
Okay, that's the stability piece. But the profitability, this is where Visa's model just seems to be in a league of its own.
It really is. The operational efficiency is kind of jaw-dropping. Their EBIT margin, so earnings before interest and taxes, sits at a staggering 62%.
62%.
Yeah.
Now, profit margin is over 50, right?
Just over 50%, yeah, 50.14%.
So how do they do that? I mean, for a company of that size, how do you keep that much of every dollar that comes in?
It connects right back to that moat, but specifically to the role they play. Visa is a processor, a network facilitator. They do not loan money.
They don't take on the credit risk.
Exactly. They're just the bridge between the bank that issued your card and the merchant's bank.
So they're insulated from the biggest risk in finance, people defaulting on their debt.
Precisely. Their margins reflect a pure processing fee on this massive global volume without the risk. They monetize the transaction, without owning the liability.
That's the foundation. So how does that translate into the recent results? I mean, if they're so stable, are they still growing?
Oh, absolutely. For the full year 2025, revenue came in at $40 billion. That's an 11% increase year over year.
11% at that scale is. That's really moving. It shows that shift from cash to digital is still very much in play.
It is. And if you look at the fourth quarter, it actually accelerated a little. Revenue hit $10.7 billion, which is 11.51% growth. And what's interesting there is that part of that was driven by some of these new segments, like AI commerce.
Okay, so that consistency is what analysts are latching on to.
Right. They're projecting that momentum continues with about an 11.15% compound annual growth rate going forward. And that's why you see the 2025 earnings per share, the EPS, projected around $11.28.
This is where I have to play devil's advocate, though. The trailing EPS is $10.20, but the PE ratio is up around 34, 35. That feels rich.
Yeah.
Are we paying for a stable utility, or are we paying for a high-growth tech company here?
That is the critical question, and the market is absolutely pricing it as a growth company. That 34x multiple isn't for the business they have today. It's for the business they're building for tomorrow. You're paying a premium for their execution in AI and stablecoins.
So if that's the case, the catalysts have to be real. Let's get into those. Where does the next decade of growth actually come from?
Well, the baseline is still that simple global shift away from cash, especially in emerging markets. But the exciting part, the reason for that multiple, is how they're leaning into new tech.
And we're talking about two main things here, right? Blockchain and AI. Let's start with stablecoins, because for a while, crypto felt like a threat to Visa.
It did. But they're not fighting it. They're sort of weaponizing it for their own efficiency. Stablecoins offer a much faster, cheaper way to settle big cross-border B2B payments.
And they're already doing this. There was a partnership, right?
Yeah, the Aquanow stablecoin partnership. This isn't for you buying a coffee. This is for expanding payment solutions for their clients in places like CEMEA.
So Central and Eastern Europe, the Middle East, and Africa. Regions where traditional banking rails can be slow and expensive.
Exactly. It's a defensive move that actually turns into an expansionary one. It keeps their network at the center of how value moves, no matter what the underlying currency is.
Fascinating. Okay, but the bigger buzzword has to be AI. They're not just using it for fraud detection anymore.
No, not at all. They're building new revenue streams on it. The concept to watch is agentic commerce.
Agentic commerce. So we're
Yeah,
talking about AI agents making purchases on our behalf.
that's the idea. So your AI might reorder your groceries or find you a better deal on your internet plan and switch it automatically without you clicking buy.
And Visa wants to be the payment rail for all those machine-to-machine transactions.
Precisely. And they're making moves. They launched that AI-powered pay later card in Vietnam with Pismo and Circle, and that their partnership with Pfizer is all about building out this agentic commerce infrastructure.
Which really shows how they're reinvesting all that cash flow. It's not just about paying a dividend, it's about funding the next wave of growth to sustain that dividend.
And that's where the speculative part comes in. The chatter is that this kind of AI agent transaction could start to go mainstream as early as 2026. If that happens, it unlocks a whole new world of partnerships for them.
Which is clearly what's baked into that high valuation. So let's shift gears a bit to capital returns, because that's always been a core part of the Visa story.
Absolutely. 18 straight years of dividend payments, and the growth rate of that dividend is just blistering.
What was the most recent hike? It was huge.
It was 28.85%. But even over the last decade, it's grown at a 17.2% compound annual rate. It's up to $2.68 per share now.
Okay, now let's touch on something a bit more complex, that Class B stock conversion. It seemed to spook the market a little after hours, but it's actually a net positive, isn't it?
It is, yeah. It's a bit of a nuance, but an important one. Those Class B shares are sort of a legacy thing tied to old litigation. They had to put $500 million into an escrow account, which is a liability. That's what caused the little dip.
But the conversion adjustment itself,
Yeah.
what does that actually do?
It effectively reduces the total number of potential shares in the future. Think of it like this.
Yeah.
By settling these old obligations, they're cleaning up the books and reducing the as-converted share count.
So it's not a buyback in name, but it has the same effect as a share repurchase.
That's a great way to put it. It mimics a buyback, which boosts earnings per share over the long run. It's a nice structural support for the stock.
And speaking of support, the technical picture has been looking pretty strong lately.
It has. The stock returned, what, 6.5% over the last month? That's more than double the S&P 500's return in the same period.
There was that big breakout day too, wasn't there?
Yeah, on December 11th, it jumped over 3%. And a lot of analysts saw that as a key technical move, a breakout above resistance that signaled a lot of institutional conviction.
And we're seeing that conviction in the price targets.
We are. Baird reiterated their outperform, but the big one was HSBC. They raised their target all the way from $335 up to $389.
Wow, that's a significant jump.
It is, and when you look at the overall consensus median target, it's sitting around $394. That implies, almost 19% upside from here.
Okay, so we've got an incredibly strong bull case here, an unshakable moat, huge margins, and these massive future growth drivers in AI and stablecoins. But what's the bear case? What could go wrong?
Well, the risks are pretty clear, even if they seem manageable. First is that litigation drag we just talked about.
The escrow accounts. That $500 million deposit is a real cost.
It is. It's an ongoing obligation that can pop up and create some volatility. The second and bigger risk is just macro, a global economic slowdown.
Right. Their revenue is directly tied to payment volumes. If people and businesses stop spending, Visa's revenue slows down.
Exactly. A deep, protracted recession is the most direct headwind they could face.
But the market seems to be betting that they can ride that out. Why is that?
It comes back to the foundation, that massive $40 billion revenue base and those 62% operating margins. They have such a huge financial buffer. They can absorb a pretty big hit to volumes and still be wildly profitable.
So the thinking is, even in a downturn, the shift to digital continues, even if the total spending amount dips for a bit. The long-term trend wins out.
That's the belief. And you have that Class B conversion providing a little structural support for EPS too. They've built resilience right into the capital structure.
So what does this all mean for you, the listener? The bullish thesis hinges entirely on that unmatched network moat, the 4.5 billion cards, combined with the aggressive capture of future growth markets like stablecoins and AI commerce. If they successfully maintain that 11% revenue CAGR while integrating these new technologies, this looks like a compelling multi-year hold, perhaps targeting levels around $430 into 2027.
That's a powerful summary. It raises a fascinating question for our listeners to consider. Given how new this technology is, how quickly do you think mainstream consumer behavior and business processes will adopt AI-driven agent transactions? And how much risk does the pace of that adoption pose to the current aggressive projected growth rates? What aspect stands out most to you?
If you found this analysis insightful, be sure to subscribe to Smart Wealth with Joshua for more in-depth stock talks every day.